Good morning and welcome back, everyone, to our Tuesday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at Options Play. And we're obviously entering this week with a very different tone to the markets after last week's um, tariff news on Thursday that drove a significant amount of volatility in the overall markets. And then Friday's news that China retaliated uh, pretty quickly and forcibly with regular tariffs as well have really significantly changed the calculus that investors have had to embark on for how tariffs are going to shape the economy going forward. At this stage, I think it's mostly important for us to evaluate kind of macroeconomic events and charts to get a better sense for how to navigate this rather than looking at individual stocks in this type of market environment. One thing that I do think is really important to understand is that if you look at implied correlations, which is the correlation of stocks, amongst the S&P 500, we've seen correlation nearly double in the last four trading sessions from prior to Wednesday. So implied correlation was somewhere around 21, 22% on Wednesday's close. It's about 43% right now. So, what that means is that stocks are moving in tandem with each other, meaning when correlation is high, all stocks are moving kind of in conjunction with each other. When correlation is low, then you have some stocks moving higher, some stocks moving lower, and when you have low correlation, that's really generally speaking a better in market environment for stock picking. But when implied correlations or correlations are high, that's really where stock picking really doesn't really get you anywhere when, if let's say, everything in the market is falling by 5%. It doesn't really matter which stocks you pick. Some stocks move a little bit more than others, but largely they move in tandem with each other. With implied correlations, or rather with correlations rising substantially over the last few trading sessions, in this type of market environment, it's better um, uh, to be trading index and ETFs rather than single stocks, regardless of whether you believe that there's further downside from here or you think that there's now a bounce opportunity after yesterday's very volatile session. So just to kind of reiterate kind of where we stand here, a couple of weeks ago, we talked about the fact that the S&P 500, after breaking below 5,800, which is a major support level, it traded all the way to 5,500. It bounced up to the $5,800 level and got rejected. And that was our first sign that, we're looking at a more bearish tone here to the overall market. And at the beginning of last week, we talked about the fact that we reached 5,500 again. We were looking for potentially a bounce. But we got all the way up to 5,700 before the first round of tariffs came into play on April 2nd. And that's really what drove the S&P 500 materially lower here. Basically, the market underpriced the risk of having a fairly broad-based tariff news that the US was going to put in place globally. Even to countries that currently do not charge the US a tariff got slapped with a 10% tariff. And then depending on how large of a deficit the US has with certain countries, that was the formula used to determine how much in terms of a tariff to slap on. And like I said, overall, they came in heavier than expected, especially with some of the major trading partners. If you look at China, you look at Japan, you look at Europe, being slapped with tariffs that were significantly higher than investors were expecting. And then more than that, it was really the news on Friday where China decided to retaliate with even further tariffs, which was something that the market also was sort of underpricing, was the risk of how fast other major economies were going to retaliate with tariffs as well. What's interesting is that, out of all of this, um, the silver lining is that the uncertainty around tariffs are gone. Meaning it's been very clear as to what the tariff rates will be across the board for most major economies. And the two biggest economies that have the biggest weight, which is US and China, even though I would say that um, it is far from concluded as far as what the tariffs will be for imports and exports in and out of China to the US. Um, the, the two biggest trading partners in the world, the US and China, have at least at this point fired their opening shots, if you will. And that gives us, at least to some degree, some clarity around what this will look like. There's certainly still room for further retaliation from the US and then again by China. If that is the case, that would certainly sour, I would say, investor confidence even further. But as of today, as of this morning, we haven't seen any major nations retaliate against these US tariffs. And that is largely what's driving a little bit of calm here in the markets today. Yesterday was actually more volatile of a day than the previous couple of days. As you can see, if you look at the size of the bar, we traded as high as 52.50 and traded as low as 48, I believe 48.30 or so. So in terms of the size of the range of where the S&P 500 traded in yesterday was the largest trading range that we've seen in quite some time. The last time we've seen trading ranges of this size was, well, even COVID, we didn't see, bars that were this large. We have to go back to the 2008 financial crisis to look to see bars that are of this size. And historically speaking, when you have volatile, violent sell-off events like the one that you've seen here over the last couple of days, um, they tend not to be isolated events, meaning they don't tend to be where you get these huge violent sell-offs here, which corresponds with a huge spike in VIX that just simply goes back to and resumes things back to normal. You tend to get these big moves here to the downside, a bit of a bounce here, and then you tend to find a bottom still is significantly lower than where we are right now. If you look at the valuations of the S&P 500, yes, we've taken a pretty significant haircut to general valuations, but that only brings us back to the long-term average from a valuation perspective. And when things really hit the fan, rarely do pullbacks get us back to average. They usually get us to below average, which gives us, again, some further downside risks here to the overall equity markets. There's a lot of things, there's a lot of factors to consider here as well. We have to consider whether or not the Fed will likely step in to kind of offset the fairly significant increase of recession. The tariffs have been put in place between US and China have certainly soured investor confidence and by a significant portion. And on top of that, you have tariffs that will likely lead to some level or pick up in terms of inflation. And the question right now is, how the Fed will be responding to this. There certainly have been cases in the past where the Federal Reserve has stepped in to lower interest rates to sort of mitigate the downside of a recession. We saw that during COVID. We've seen that in the past. However, the difference that we have this time is that at the moment, inflation is not, hasn't materially picked up just yet in terms of hard data. The labor market, we just had a jobs numbers that came out last week that was significantly stronger than expected, and the unemployment rate is fairly manageable around 4.2%. So, the hard data does not show a recession yet. So the Fed has plenty of potential room to have to just wait and see before they need to act. And in that meantime, there could be some significant volatility and significant deterioration of consumer confidence and consumer spending. So that is one thing to factor in, is that right now, even though there's been a pretty significant change in terms of expectations for rate cuts for this year, we went from about expected two rate cuts prior to the tariff news. Right now, the market is pricing in five rate cuts for 2025. So that's been a pretty significant change here um, in the U.S. equity markets right now. So if we look at kind of important levels on the S&P 500, probably the first important level is around 5,400. That would be the first upside target here on any bounces. And right now, if you look at futures, we're opening up just around 5,230. So we're about 170 points away from that 5,400 upside target here on SPX. Um, if we get a little bit of follow through here on volume today, because pre-market, it's been, or rather the overnight session has been a relatively strong um, output here from the S&P futures. So we'll continue to monitor that and see how that progresses here throughout the day. But our upside target is around 5,400 here to the upside on the S&P 500. If we get to 5,400, that's really kind of where we start running into some pretty significant resistance. You have resistance at 5,400, you got resistance at 5,500, and you got resistance going up to about 5,550. So historically speaking, that's likely where any rallies will stop and potentially reverse back lower here. Um, and it's really hard to say where the markets are going to go, because largely this is going to be driven off of any potential new information that comes out with regard to tariffs, right? Whether we get sort of good news that the US has managed to negotiate with certain partners, whether that's China or other partners throughout the world, to potentially lower the tariff rate that's going into effect, either earlier this week or on Thursday. Or we could see more discouraging news if other countries choose to retaliate in terms of tariffs. So it's really impossible to say and predict how that's going to play out, which is why in this type of market environment, we have to be incredibly nimble on a daily basis and be ready to effectively change our directional views on a dime effectively with the introduction of any potential news that can drive markets. If we look at kind of the wide range that the markets traded at yesterday, that was due to initially a false rumor that there was potentially going to be a 90-day reprieve on the tariffs that ended up being false. And so, you had the NASDAQ up 6-7%, sort of in the morning, and then back down, 4 or 5% in the afternoon before it settled back to kind of break even at the end of the day. But intraday swing wise, it was one of the largest moves we've seen historically on the S&P and the NASDAQ 100. So there's really a lot of news and a lot of information to digest, but in the short run, expectations are going to be that volatility will remain high, and that if for investors who want to trade in this market, you have to remain incredibly nimble, and effectively be ready to change your entire directional view on the market on a dime as new information comes out, and just how, generally speaking, how markets react to this. So, if you look at the other indices, if you look at the NASDAQ 100 here, like I said, we ended up flat here on yesterday, but very similar to the S&P 500, very wide range that they're traded in. Today we're opening up a little bit higher here. If you look at the Qs, we are opening up just around 433 or so. So you're looking at around right there. So we still have that gap to fill around 450. And you have to look at kind of the 465 range as kind of your upside target. If it does get there, that's really where you start falling. You start running into a wall of resistance here around that 455. And a 455 area is really kind of the big resistance level here on the Qs. Small caps, obviously very similar price action here. The upside target here is around 190 on IWM, which is around right here. And then you have another big resistance here around 199, around 200 or so. So, the question is really kind of how markets shape up here today. Obviously opening up fairly strong here. The question is whether that can follow through here for the rest of the day. Equal weight S&P 500 is quite poor here as well, really speaking to the fact that the sell-off was very broad-based. There really weren't any sectors or industries that were spared from the overall sell-off here. So be very nimble here in the broader markets. Commodities have taken a bit of a free fall here as gold and silver, base metals and oil has really taken a hit here on the back of concerns around demand, because as we head into a potential recession, demand for those types of commodities tend to lower. And that's really the downside risk that we continue to see here with commodities. I would say another big shift that we really have to pay attention to right now is in the bond markets. We've seen that the bond markets have really started to give us some signals that we haven't seen in a long time, which is the fact that there's concerns around credit risk from the bond markets. You look at high yield, this HYG, which is the high yield bond ETF, seen a significant decline here. And yesterday's price action wasn't particularly strong and soothing here. So this is really where I think the bond market is telling us some information that is really relevant for traders to understand that, with the VIX trading at around 47%, even after yesterday's kind of big move, really speaks to the fact that investors are very concerned going out the next 30 days with regards to where equities will be, and that there's a assigning of relatively high probability that equities could be significantly lower than where we are right now if you look at around 30 days or so. Like I said, historically, big moves like this in terms of VIX tend to not be isolated events. Many times what we do is you get a bounce and then you find a new bottom, 4 or 5 weeks later. What's interesting is that initially the move kind of brought yields down below 4%, but then we're back up to 4.3% here very quickly. And this really speaks to the bigger picture here. There's a lot of chatter around tariffs and what the tariffs will be and what other countries will do. But I think the bigger question that we have to ask ourselves is really kind of taking a step back from tariffs and taking a look at kind of the global economy as a whole, and think through kind of what are the reasons for tariffs, and why do we want to put tariffs in place, and what are the potential outcomes that are that can come out of these tariffs. Because ultimately, this all comes back down to the fact that the US has been on a path for the last few years of growing the debt pile to a fairly unsustainable level. And we're certainly continuing to, the debt pile just keeps getting bigger and bigger. And it's getting to a point where investors are concerned around the safety of US treasuries. At the moment, even though the US is still by far the dominant funding currency in capital markets around the world, um, this is starting to put some strain on that. on that, and potentially using the German bond or the Japanese bond as a funding currency is starting to be more and more of a discussion point where, if you go back even just a few months ago, that would have never been the case itself. So, we've seen the higher end of the curve, you looked at 10-year yield climb as a result of the fact that treasuries are being sold off at the moment. Even on yesterday's move, we're starting to see treasuries um, you know become further unwanted. So you kind of have this sell-off that is in conjunction of treasuries and the S&P 500. It's definitely a concern right now. And this is something that we have to keep a close eye on as to the treasury market, the health of the treasury market, and just how investors are viewing US treasuries globally and any potentially lack of confidence that starts to creep in with regards to the safety of treasuries. So at the moment, there's not enough to be worried about. However, there are enough things to kind of be aware of that there could be some problems down the line if we continue going down this, and the confidence in the ability of the U.S. government to pay back their debts starts to once that becomes a question, that's when things can unravel fairly quickly here. And we are whether you are a fan of Elon Musk or not, and the Doge department, there's no doubt that the US government has to, in some way, shape, or form, figure out a way to reduce the deficit and the amount of debt that we have. Whether you agree with tariffs as the way to go about doing so, is up for debate. But regardless, there's no question that the amount of debt that the US has is becoming more and more unsustainable. And if we keep going down this route, no amount of tariffs can save us. And that's really why I think sometimes we have to look past the tariff headline and really focus on what's more important right now. And I think the treasury market is arguably more important to be paying attention to right now than equities, even though the two are very heavily tied together at the moment. Um, Looking at kind of Bitcoin has sold off alongside with it. We've seen the dollar index kind of get rejected here at that 103.5 level here. Bitcoin's trading just under $80,000 here right now, even though it hasn't fallen through here. There is some further risk of downside here for Bitcoin. Gold has pulled back here to the 50-day moving average around 3,000, which is a potential buy. I'm sorry, 2,950, which is a potential buying opportunity for, if you still believe in the safe haven uh, status of gold, which at the moment, if you look at the amount of hoarding of gold by central banks, that trend has not seemed to um, dissipate. If anything, it's gotten stronger here. So the pullback here to that 2950 50-day moving average is a potential good buying opportunity for investors. Oil continues to trade lower here below that 52-week low. We're now trading at $60 on West Texas Intermediate. So oil has kind of been in a bit of a free fall here. And overall, technology and consumer discretionary are two sectors that are starting to show some weakness here. Or I'm sorry, have continued to show weakness here, while sectors like communications, financials, consumer staples, healthcare, utilities, even real estate have shown a fair amount of strength here at the moment. So that's kind of where we stand here right now. Like I said, at the moment, in my opinion, it doesn't make sense to be picking individual stocks. You're better off trading kind of the indices because correlations across individual stocks right now are much higher. Stocks tend to be moving in tandem with each other at the moment. So it's better to trade a basket of stocks rather than relying on a single stock. Um, And at this stage, really, the you have to stay nimble. Expectations are that volatility will remain relatively high, at least over the next few trading sessions. Hopefully, by the end of this week, the S&P 500 manages to close above 5,100, and we can take on a more the markets can start settling down a little bit here. But if we end ourselves below 5,100 at the end of the week, which is very possible, I would say you have a bit of a 50-50 shot of one way or the other at the moment. Regardless of which one of those scenarios play out, you have to be prepared for it. Each and given day to be looking at the markets in the first 30 minutes and get a sense for who's got control, who's moving the markets, and effectively following the trend here over the next couple of weeks. And I will be back here every single week to update you on where we currently stand from a bigger picture perspective and help you, gather that directional view that you might need to navigate the current volatility. But the volatility right now feels scary. It is scary. If you are trading options, this is a potential opportunity to collect some premium because the premiums right now are incredibly juiced up, and you can collect a significant amount of premium selling options if you get the directional view correct. So that's really where, from my perspective, this week is going to be a pretty pivotal week to um, look at kind of the overall markets and see how it responds to any potential news that might come out with the tariffs. But so far at this morning, it looks like markets are stabilizing a little bit. But I wouldn't get too comfortable with that as we start to reach that 5,400, 5,500 resistance level in the S&P. I do expect that that's going to face a bit more of some resistance here. And potentially start trading lower once we reach those target prices to the upside. So with that, that covers what I wanted to share with you here today. Like I said, there's a lot going on. You have to stay nimble, and I hope that this is helpful in giving you a better understanding of what's going on and how to play this market condition that we find ourselves in. With that, I hope you guys have a good week, and I'll see you guys here next Tuesday. Thank you so much.